All right, let's just be real for a second here. You open up your app, you look at your screen, and boom, there it is. The numbers are red. Your hard-earned profits are literally disappearing right before your eyes, and maybe you're even starting to see some outright losses. It is a deeply visceral, completely painful experience because, quite frankly, seeing your portfolio tank is just not a good feeling. So welcome to today's Explainer, where we're going to tackle one of the absolute hardest, most stressful parts of investing head-on. You know the exact feeling, right? In that very moment when the numbers are bleeding red, it is so incredibly easy to panic. Your pulse quickens, and this specific, terrifying set of questions just starts racing through your mind. You look at your balance and think, wait, should I sell right now just to protect what I have left? Or, man, what if it drops even more tomorrow? Or the scariest one of all, am I making a massive mistake here? Look, if you've ever felt that tight knot in your stomach, I really want to validate that for you right now. You are absolutely not alone. Every single investor goes through this exact same anxiety. But here's the critical difference we need to establish right out of the gate. Successful, veteran, long-term investors, they don't magically avoid market drops. They don't have some secret crystal ball that gets them out right at the top. No, instead, they just learn how to stay calm during the storm. They know how to control their emotions and stay entirely rational when the market takes a hit, instead of letting fear grab the steering wheel. Okay, let's dive into this. To help you build that kind of bulletproof calm, we're going to follow a highly structured roadmap today. Number 1, the panic of red. 2, mastering your market mindset. 3, taking rational action. 4, the hidden opportunity. And finally, 5, your volatility framework. Starting right off with part 1, the panic of red, and acknowledging our deep-seated instinct to flee. Which brings us to section 2, mastering your market mindset, or basically, fixing the brain. To master your mindset, we first have to understand why staying calm is so insanely difficult. Well, it's actually a feature of human biology. Your brain is literally wired by thousands of years of evolution to avoid loss. So when the market drops, your brain's alarm bells are screaming at you to run away. In that moment, almost everyone hyper-focuses on the short term just to survive. But you have to shift your baseline expectations. You've got to zoom out. Think about the timeline. Over one single year, the market might be up. At year 2, sure, we might hit a severe correction and take a dive. But as you zoom out to 5 years, you start seeing the recovery. At 10 years, you see the massive long-term growth trend. If you expect volatility from the start, you stay prepared. A short-term drop isn't the end of the world. It's just a tiny, perfectly expected valley within a much larger mountain range of growth. You constantly have to remind yourself of history. Market drops have happened many, many times before. And guess what? Every single time, the markets have recovered. Again and again. You know, the absolute most dangerous phrase you could ever utter during a downturn is, but this time is different. It almost never is. You've got to internalize the fact that recovery isn't just some hopeful wish. Recovery is a fundamental, mathematical part of the economic cycle. Moving right along to section 3, taking rational action. This is all about fixing the behavior. So how do we actually fix our behavior when the red numbers start flashing? Well, the very first thing you must do is revisit your original plan. Why did you buy in the first place? Was it for long-term growth over 20 years? Was it to build a nest egg for retirement? Contrast that highly emotional reaction of panic refreshing your app, desperately hoping the numbers magically change, with the rational action of just stepping away, giving your mind a much-needed break. Staring at your phone is literally not going to make the stock price go back up. If your long-term goals didn't change overnight, your strategy absolutely shouldn't change overnight either. And hey, another absolutely crucial part of rational action is managing your exposure. If you invest too much money, like money you might actually need for rent or an emergency next month, every single downward tick feels like a physical punch to the gut. When that financial pain spikes, emotions take over. And that is exactly when you make bad decisions. You really need to invest in an amount you can handle emotionally, not just financially. On top of that, true confidence comes from understanding. If you actually know and trust the underlying businesses you own, a short-term price drop feels way less threatening than if you just blindly threw your cash at a random ticker symbol you saw online. All right, section 4, the hidden opportunity. Time for a major shift in perspective. This right here is what separates the novices from the seasoned veterans, and it requires a profound cognitive reframe. When prices go down, most people look at their balance and just see their wealth evaporating. But experienced investors, they look at the exact same red numbers and they see incredible value. Think about it like this, because the psychology is actually deeply ironic. When you go to a store and your favorite shoes or gadgets are suddenly marked down 20%, what's your reaction? Excitement, right? It's a great deal. You probably want to buy more of it.
But when the stock market goes on sale and suddenly strong, highly profitable companies are 20% cheaper, people react with absolute terror. They want to sprint out of the store. A market drop is literally just a massive sale on assets. Think about it. If you liked a solid company at $100 a share, you should absolutely love it at $80.
So the crucial point is pulling this all together. Section 5, your volatility framework. This is your ultimate survival summary. Here's your simplified 8-point framework. Keep this burned into your memory. Number 1, expect volatility, so you are never caught off guard. 2, zoom out and always remember the long-term trend. 3, stick to your original plan. 4, manage your exposure so you can actually sleep peacefully at night. 5, check your portfolio way less often to basically starve your anxiety. 6, truly understand the investments you own. 7, flip the script and see drops as incredible opportunities to buy assets on sale. And finally, number 8, control your emotions. Remember, you're human. You are going to feel fear, and that is perfectly okay. The goal isn't to somehow eliminate fear, it's to stop that fear from dictating your actions. So what's the big takeaway I want you to grab from this explainer? It's a highly practical, actionable plan for the future. The very next time the market takes a dive, and you feel that heavy, rising pressure in your chest, I want you to do 3 incredibly simple things. Just pause, do not touch that sell button. Breathe, let that initial crazy rush of adrenaline pass, and then go back to your strategy. Because at the end of the day, market drops aren't the problem. They are a completely permanent, unavoidable feature of investing. Your reaction to them is the single only thing that actually matters. Panic will always lead to mistakes, usually locking your temporary paper losses into permanent real ones. But discipline? Discipline leads to results. Over the long run, the investors who manage to stay cool, calm, and collected are the ones who ultimately win the whole game. So the next time everything turns red, you've got to ask yourself, are you going to be the prey running away in fear or the predator hunting for value?